can we quantify yet what Syria is going to require in terms of funding and investment to get back on a stable economic path?
Good morning, Dan, and thank you very much for having me. So Saudi has definitely emerged as a key regional player helping Syria in a post-war situation. We've already seen that President Trump had announced the lifting of some sanctions in his previous trip to the GCC while he was in Riyadh. And in terms of the investments, in terms of the reconstruction and the funding needs that Syria has, we've seen a repayment of some of the World Bank loans over the last couple of months from some key GCC countries that has enabled Syria to be able to engage with the World Bank again and with other multilaterals. There are estimates out there, Dan, that point to funding needs and reconstruction needs to rebuild Syria between 250 and 500 billion dollars. So it's going to be quite a significant task at hand, especially in the context of lower oil prices within the region.
Indeed, Carla. So do you expect the Gulf economies to front up that capital, or will this also require private sector participation as well?
The way we see it at these levels of oil prices, yes, there may be willingness at a government level to engage at a government-to-government level, but we will definitely have to see mostly concessional funding, multilateral funding from the World Bank, potentially maybe even the IMF, in order to consolidate this funding in a comprehensive package that can be directed to where the urgent needs are really in the near term.
Carla, let's also talk about the economic state of play in the region as we push into the second half of the year. And your latest note from Standard Chartered really highlighting growth in the GCC being a bright spot over the next couple of months. What would you say makes the region so resilient despite some of these geopolitical risks and, of course, the commodity price volatility as well? And in particular, how are you factoring in the current tariff headlines when it comes to the outlook for our part of the world?
What makes the region more resilient, Dan, is the fact that we've spent the last 10 to 15 years on an aggressive and very serious reform program. So every individual country has undertaken specific fiscal reforms and structural reforms to embed more resilience into the economy to be able to face these external shocks, specifically on oil prices. So if we compare this period of relatively lower oil prices to, say, post-2015, when we had the severe crash in oil markets, the economy is responding differently because the policy settings have changed. And this is what's making our view more constructive, and this is what's making the real non-oil economic growth perform at much higher levels than the global growth. So the global average right now is about 3%, still not quite bad compared to the fears we had earlier in the year as a result of the tariff threats. But the non-oil economies of the GCC are growing anywhere between 4 and 5%, depending on which economy we're referring to. The tariff threat is definitely something that we've priced in and we've accounted for within our forecasts. The way we look at it as a research team is that in the first half of the year, we had the threat of tariffs, we had tariff uncertainty. Moving into the second half of the year, we're looking at tariff implementation with many deals being agreed, whether the UK or Japan, just overnight. So now we're actually looking at the real economic impact of this tariff implementation, whether into the US economy or other major economies. For the GCC, for the Middle East region, we think the direct impact is quite limited. Trade exposure to the US is quite small and not as significant as it used to be historically. And there are opportunities for the GCC to deepen trade relationships in that sort of south-south economic corridor, trade corridor, in addition to doubling down on investments to the US, just like Japan also pledged to do overnight.
And Carla, when you look at, of course, what's happening with trade and tariffs, you also have to assess what's happening with the price of oil as well. Over the last couple of months, we've seen OPEC front-loading these output hikes. Just walk me through what you expect that to mean for the large exporters like Saudi Arabia and UAE in terms of economic growth moving forward.
It means higher economic growth. So for the last couple of years, we had seen oil growth super muted, if not quite negative, deeply negative. And that was acting as a drag on headline economic growth. Going into the second half of the year, and as OPEC front loads this planned production increases, we expect that to filter and to feed through GDP headline figures quite aggressively, and we're going to see an uptick in GDP figures as they come out. We have Saudi's GDP print coming out just next week, and we expect oil growth to start picking up in that GDP data release next week and in forthcoming quarters as well. So it definitely means higher economic growth for the likes of Saudi, the UAE, Iraq potentially as well, after years of muted oil growth and the non-oil sector really doing the heavy lifting and driving economic activity in these economies.